Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Sometimes what you want to do is to look at what big investors are buying. Okay, the super investors, the hedge fund boys, what are they buying currently? Okay, and that kind of gives me an idea of the types of stocks to invest in and do a bit more research about and so on. Okay, because remember, they have billions of dollars lying around. They have a team of researchers and so on. Sometimes they don't even beat the market, but it's good to know that that's basically what they're buying, and then see if there is a chance for us, just like the retail investors, to actually buy some of those stocks as well. Okay, so there's a website where that shares all that information with us. They have to declare with the SEC every single quarter. So by the time this data comes out, it might just be too late for us. They might actually be bought and sold it, and because sometimes they do actually sell stocks as well. Okay, but it's a good indication to see what kind of stocks they're buying. So by the time they declare it, the stock might have gone up another 10%, 20%. We might be too late to buy it. So you have to be careful and you have to do your research. So I'm going to look at the 5 stocks today, and the first one that we're looking at is Visa. Okay, we had 7 people buying Visa. 7 different hedge funds actually bought Visa, and it was quite substantial in terms of the purchase. Okay, so let's have a look at the financials and see why they might actually be interested in this company. When you look at the net income of this business, okay, you're looking about almost $13.5 billion. The profit margin is almost 50%, and return on equity is 40%. Free cash flow of $15 billion on a company that is about $400 billion company. Okay, currently trading 187, so I think my average is about 200, so I am down quite a bit. So I'll share that with you towards the end. P is slightly high, and price to sales, normally for these type of companies, I'm looking for price to sales below 15, but slightly higher than P. Okay, EPS, and you basically looks like it's growing from now till the next year. So EPS next year is about $8. Right now we're looking at about $5. So okay, current ratio just above 1, so it's a little bit volatile. Beta a little bit current ratio is good, because that means the next 12 months they have enough to cover their debt. Beta is actually below 1, so which is nice. Margins is really good, operating margins, and sales, you're looking at about $27 billion and of sales just last year. And the last 10 years, if you hold this company for 10 years, you will have total return, including price appreciation as well as the dividends, of almost $23 billion. Okay, it's a really solid business. When you look at the financial, when you look at the revenue and free cash flow here, you're looking at 2018, just about $20 billion to right now $26 billion, almost $27 billion. Okay, and then look at these profit margins. They've made basically almost $27 billion, but they have actually gross profit of $21.68 billion. That is ridiculous. So they don't have much of an overhead, to be honest with you. Okay, and look at the EBITDA from $14 billion to right now $17 billion, and free cash flow is about $12 billion in 2018, and right now we're looking at about $15 billion. So it's really solid business. When we look at the valuations, you can see Morningstar is saying basically about 14% discounted at the moment. Their price tag is $221. Similar for Simply Wall Street, Tip Ranks, they all agree the price should be way higher than where it is right now. Okay, and the next 5 years, they're expecting, the Yahoo Finance analysts are expecting they basically and next 5 years, sorry if I can talk, 18% growth. Okay, and that's per year, by the way. Okay, and then it has a wide economic moat if you think about it. And performance wise, year to date, we're down about 13%. Okay, so this is solid company. So that's probably one of the reasons, because it's down. It has amazing free cash flow, is growing, and the top line, as you can see there, basically they actually, a lot of the gross profit, a lot of their revenue is actually going to the gross profit. Okay, and then you've got net income of $13.5 billion, which is really good. So that's a solid business. The next company we're looking at is Microsoft. Microsoft had basically, there was 12 different hedge fund managers that bought Microsoft. Okay, just the last quarter. And as you can see here, there's a reason why, because look at this net income, $72 billion, profit margin was 37, return on equity 47, we're looking at free cash flow of $63.6 billion. Okay, and it's over $2 trillion, has a $2 trillion market cap. PE is slightly higher, okay, but price to free cash flow is actually the range that we're looking for. EPS is definitely growing. Current ratio is actually perfect. Beta is low, and operating margins of 42%. Okay, sales last year was $192.56 billion, and right now we're looking about last 10 years. If you hold this business for 10 years, you would have made about $31 billion, 31%, not 31. I wish we did that. Okay, I wish you can get $31 billion, but it's 31%. Okay, in terms of looking at their revenue to free cash flow, you're looking at about 2018, it was about $110 billion to right now $192 billion, which is basically that sales that you see there. So this is really great business, and look at how much of that revenue is actually going straight into the gross profit. 132 of the 192 actually goes in there. They spend about $60 billion of the cost of their revenue, and it's a huge company, obviously. Okay, and when you look at the EBITDA as well, look at this growing. It's about 50 billion in 2018 to right now $85 billion, and free cash flow from $32 billion to $63 billion. That's almost double. That's really good. Okay, I don't know if that is gonna be the trend in the going forward next 5 years or whatever, but it gives me good idea that this is a well-run business. Okay, dividend is quite good. Dividend yields actually good. Payout ratio and 5-year growth rates and dividend safety, they are all in the right track. Basically, this is basically what we want. Okay, if you can get 5-year basically every year, I think they raise about 5-6%, and that's 5-6% that you didn't have to work for. You just buy it and company and hold it. Okay, Morningstar is saying that right now is about 30% discounted, 36% for Simply Wall Street. Tip ranks is almost the same, and Yahoo Finance is saying $360 per share. And as you can see, the Simply Wall Street is the only one that's very bullish, but the rest of them is around the same price. Okay, and the next 5 years, they expect this to grow about 16%, the earnings to grow about 16%, and it definitely has a wide economic moat. So right now it's down about 27% for basically for this year. So again, another reason why these people are buying it. When you look at this type of financials and you look at the fact that company is down, no wonder they're buying this company. Absolutely brilliant business. The next company we're looking at is MCO or Moody's. This is one of my other favorite companies. The S&P Global and this company is basically very, very similar. So I do own SPG and SPGI, but I don't own Moody's yet. I might actually add to my portfolio if it comes back down to where I want it to be. But yeah, they're very, very similar, those two. They're in the financials, $257 billion market cap. 47 billion market cap right now. But net income, almost $2 billion. Profit margins is really good. Return on equity, excellent. And then they have a 1.6 billion in free cash flow. Okay, PE is slightly high. Okay, but price to sales is actually nice. EPS is definitely growing. Current ratio is above 1. Beta is above 1 as well, but we want it to be lower because we don't want it to be too volatile. And when you look at the operating margins, okay, you can see the operating margins of 43%. And then when you look at the sales last year, they made about $6.14 billion. And if you hold this business for 10 years, you would have made about 24%, okay, on your money. When you look at the last 5 years, okay, you're looking at about $4.4 billion to right now about $6 billion. So it's definitely heading in the right directions, from $3 billion of gross profit to right now $4.5 billion. EBITDA is also growing in the right directions, from $2 billion to right now $3 billion in the last 4 years. Free cash flow 1.3 to right now 1.6. I would have liked this to grow a little bit faster, and that's the only reason I'm a little bit hesitant of basically adding this to my portfolio. But that definitely covers in the dividend of $2.80, and the yield's only 1%. Payout ratio very nice, 24. So they have room to grow this. Last 5 years they grew this about 11%, and dividend safety 83%, which is very safe. Morningstar is basically saying right now the price should be $350. That's 28% discount. Simply Wall Street more or less the same, and then Tip Ranks is the only one that's kind of bearish, and they saying it's still 324, about 12% upside. Yahoo Finance at $321 per share as well. Next 5 years they're expecting the earnings to grow about 5%, and definitely has a wide economic mode. And as you can see, it's down about 35% for the year and 37 from this all-time high. So another business they're looking at the moment. Okay, so the next one we're going to look at is the fourth company we're looking at is SPGI. This they're buying about six different hedge fund managers actually bought this, and the Moody's, it was actually 7 of them bought it. So they are very similar, like I said at the beginning. Okay, S&P Global is actually very similar in terms of data. They deal a lot of the data, commodities, and obviously giving credits to different companies and so on. But it's slightly, actually way bigger than in terms of market cap than Moody's, $113 billion. And as you can see, they have a lot more net income, is about $3.5 billion. Profit margin is excellent, return on equity excellent, $3 billion in free cash flow. Now, when you look at their PE, it feels like it's a little bit high, but when you look at their PE in comparison to the average PE in the last 5 to 10 years, is actually quite low. Price to sales is below 15. That's what we're looking for. Is really good. In terms of EPS, is going the right directions. Current ratio is perfect. Beta is actually slightly above 1, so we're not worried too much about it. Operating margins is excellent. Okay, sales $8.67 billion, and the last 10 years you would have had made about 14% on your money. Right, when we look at their financials, when you look at their from $6.2 billion of revenue of 2018 right now to about $18.6 billion, which is really good. And then when you look at the gross profit of that, is actually quite nice, from 4.5 to right now 6.2. EBITDA is also growing the right direction, so $3 billion to right now $4.4 billion. And free cash flow, again, $1.9 billion to right now basically $3 billion. They have a nice dividend. Okay, it's just 1%, but it's about $3.40. Okay, payout is very low. 5-year growth rate is 16%, and the dividend is really safe. Morningstar is actually giving this company 23% discount right now. It's saying $410 per share. Again, similar sort of evaluations all across, about 400 apart from simply Wall Street. And next 5 years was what are we expecting? We're expecting the earnings to grow about 12%. Okay, and it definitely has a wide economic mode. Performance year to date is, just as you can see here, is 33%. Right, the final company they're buying is Starbucks. Obviously, you know this company. Right now, in terms of their market cap, you're looking at about $81 billion. Net income of $4.4 billion. Profit margins really good. Return on equity is minus, and I think that's negative equity situation going on there. Free cash flow here, $3.6 billion. And when you look at their financials, in terms of PE is really low. Price to sales is very good. I mean, in terms of increase wise, I think they expecting the earnings to grow, not grow as much obviously next year, so there's a decline. That's probably why it's actually down quite a bit next year. When you look at their last 5 years, okay, $24.7 billion to $31 billion. $8 billion of that actually was the gross profit. EBITDA is heading the right directions. Okay, it's growing, but it's not growing a lot. Okay, it's also declined because of COVID 2020. And when you look at their free cash flow, from $9 billion to right now $3.6 billion, that's probably why they suspended the buyback situation. There's union situation going on, so there's a little bit more story to this. Okay, so that you have to be really careful if you're looking at this company. Dividend yield is just basically, it's really good, 2.76%. Payout ratio 50%, which is nice. Okay, 5-year growth rate is about 17%, and dividend safety of 67%. Now, in terms of discount wise, Morningstar is actually saying about 30% discount. The price should be about $100, more or less the same with simply Wall Street and Tip Ranks. And Yahoo Finance, an analyst, is actually saying about $94 per share. It definitely has a wide mode. Okay, next 5 years they're expecting the earnings to grow about 7.88% for every single year. And when you look at the performance year to date, you're looking at about 40% basically down at the moment. So yeah, that's another company they're buying, and there were 6 people, basically different hedge funds that actually buying. And what I did was I looked at the data Roma and I picked the companies that are Sharia compliant, that are down at the moment, and they basically, that are some of these guys are buying. Okay, and that's what I wanted to share with you guys. I will do similar basically a video for the ones that are not non-dividend, and hopefully you enjoy this kind of content. And if you do, just give the videos a like, subscribe to the channel if you haven't. Have a wonderful day. Assalamu Alaikum. Take care.